Hello, I'm Juliette Sarli. In this week's edition of IG Macro Intelligence, we take a look at the ASX reporting season so far, with a focus on the hits and misses. Investors have severely punished companies which failed to meet or beat market estimates, with some companies seeing double-digit losses in their share prices on results day.
I think that the way we would look at reporting season, it's deliver or die. And I don't think it's really about valuations in terms of whether you can deliver. If you deliver it and you still look expensive, the market will reward you because it's actually sort of you're coming in on expectations. I think that valuation is not helping you, or the degree to which it's helping you if you disappoint is sort of not particularly great either. So by and large here now, you need to deliver. And if you do, hopefully it allows you to maintain your price and your multiple. But if you don't deliver, you're going to see what's happening.
One company which did deliver was Australia's largest bank and stock by market capitalisation, the Commonwealth Bank of Australia. CBA reported record first half cash earnings thanks to robust growth in lending and deposit volumes. Cash profit after tax rose 6% in the 6 months to December to $5.45 billion above estimates. Shareholders will receive an interim dividend of $2.35 per share, higher than last year's payout and above consensus.
CBA result was an absolute ripper. I mean, I was shocked with the quality of the results. But then when you read through it, you go, why am I so surprised? So what happened with CBA there was they delivered volume growth that they haven't delivered since 2008. Just let that wash over you. It's a long time since they delivered that sort of number.
And CBA shares soared after the results, despite analysts remaining overly bearish at these levels. ASX TradeWatch data showing CBA shares are in a long-term downtrend, specifically when looking at the 200-day moving average. But despite the bumper result, many analysts still think CBA, the most expensive banking stock in the developed world, is overvalued, with the average broker recommending investors sell with an average price target of $127.93, suggesting it's about 30% overbought. CEO Matt Comyn isn't worried.
What matters most is the long-term performance. From a management perspective, we need to think about and be very focused on what we know will support sustainable and long-term performance. And that's obviously continuing to acquire new customers, do a great job serving those customers wherever we can, helping to support both either their dreams or the growth in their businesses, and being able to do that responsibly and comprehensively over the long term. If we take care of all of those things with a highly motivated and engaged workforce with the best technology, and we continue to invest through this cycle, then the performance will take care of itself.
Well, heading the other way, healthcare stocks like Pro Medicus, CSL and Cochlear received a health check after their earnings, with investors pressing the sell button. Pro Medicus shares fell 24% to a multi-year low on the day of its earnings, with its record results falling short of expectations. Shares appear to be in a long-term bearish trend, confirmed by multiple indicators. Barrenjoey upgraded the stock, though, to overweight, saying Thursday was a bad day to be a software stock in light of AI disruption concerns on Wall Street. Other brokers similarly upbeat, with the average target price, as surveyed by Refinitiv, suggesting PME can rally a further 80% from current levels. CEO Dr. Sam Hupert telling AusBiz their pipeline outlook remaining solid.
We're seeing opportunities across all of the market segments, from large academic centres that we have the biggest foothold in, large IDNs, and now the private market. So we see a lot of opportunity. We see opportunity now for our new cardiology offering, and we signed some of those in the first half, including a really big one with Colorado, which we're about to implement in the next month or so. So from a pipeline and from the contracted sale point of view, we think we're sitting in a strong position.
Well, Cochlear shares also got smashed after its result and appear to be in a long-term bearish trend, a signal that investors see little opportunity in owning the stock. UBS, though, has a buy rating on it, with a $350 price target, expecting a recovery throughout the remainder of 2026. CEO Dig Howard not concerned about broker views that the stock is no longer a good dividend play.
Long history of growing profits and dividends and growing revenue. We have that because we have a huge market opportunity and the strategies and the capability to execute on that growth. We don't see anything in this result that changes that outlook of the need for our products, the potential of our products, and our ability to execute on our strategies to deliver growth.
And that is your IG Macro Intelligence. We'll see you next time.